keynote session with Lasse Pedersen. So Lasse, thank you for joining the conference. We're really happy to have you here, and your work is obviously relevant to the sort of topic and mission of financial information and how it's going to evolve and develop in the future. If I were to sort of introduce Lasse, I would just say, one thing, that he's one of these very special people who were able to combine a prolific sort of academic career with a very successful career in the investment management industry as well. So so he could see sort of both sides of the ale. And so today he's going to talk to us about a topic that it's a recent academic project, but I have a hunch that it's actually largely informed by what Lasse saw during his years in the investment management industry and sort of interacting with the markets on a almost daily basis. So now, without further ado, Lasse, thank you so much for being here, and the screen is yours for 1 hour.
Well, thanks a lot for that introduction. So this paper is called Game On: Social Networks and Markets. And just as a way of background, I think that social networks is a very interesting topic. I think social networks, so meaning, who you're connected to, who your friends are in the real world, and who your friends are online, and who you follow online. I think those kinds of issues have probably influenced equity trading since the very beginning of equity trading in the 17th century. So equity trading started on the Amsterdam Stock Exchange in the 17th century. And in a famous book by De la Vega, he talks about how trading clubs were important back then, and these social connections seemed to be definitely important right from the beginning. And also, actually, London Stock Exchange started shortly after. It actually literally started in the coffee houses of the London Stock Exchange. And a recent book by Standards talks about how people were sitting in these coffee houses talking, how the South Sea bubble played out in the coffee house. And he calls it the coffee house internet of the 17th century. So, social connections have been always important, I think. But what's new now is that these social networks are becoming larger because of the internet. And also they're becoming more observable. So it's not just that we know that people talk. We can, in fact, some of those discussions are written and we can see them online. And so one prominent example is GameStop, which is inspired the title and something in the paper, which is a retail store where you can buy computer games. So here is the Stockholm GameStop, and you can see it certainly looks like a $12 billion business. It is the globally the biggest computer retailer. They just have one problem, which is people don't buy computer games in stores anymore, than buy them online. And so for that reason, the stock price has been very low for a long time. It's been trading below $20 per share throughout 2020. And a lot of professional investors thought the value was, probably less than $20 per share and maybe even going to zero. And then in January, suddenly the price went above 300, then it collapsed to around 40. And this is, as of today, it's trading around 177. So it's a pretty wild ride, and there's been a lot of discussions on social media. There's been a lot of people, hyping up this stock on social media. We see a $2 billion deli on the stock market. We see Bitcoin having a huge value. We see Elon Musk tweeting about GameStop. He's tweeting about Dogecoin. He's tweeting about Bitcoin. All these things are being hyped through social media. And what this paper is trying to do is trying to have a model where people trade based on what they learn from the social network, and also try to apply it to the GameStop situation, but in fact broader than that, I hope. So what the paper does, it's a theoretical model, and it tries to, as simple as possible, try to capture these phenomena. So I have a model that delivers closed-form beliefs, prices, and portfolios. And in terms of the beliefs, what we see, and hopefully it'll be clear in this talk, that beliefs spill over from one person to the next. So if I'm talking to Michael, then I influence his opinions, and then he might be talking to Cherie, and then, you know, I may influence Cherie in the second order, and so forth. What then happens is that people's beliefs converge over time, but not in my model to a consensus, but rather to a mix of what is a rational view, but also what might be a fanatic view. And we'll see that there are some kind of echo chamber effects that lead that certain opinions, the opinions turns out of stubborn people, whether they're stubborn because they're rational or stubborn because, so in a sense, quote unquote stubborn, I'll explain what I mean, that the rational have a form of stubbornness, but also other fanatics can have stubbornness, and those views end up becoming important. But other people who are more flexible and update their belief based on what they learn from others, they too can be important, and I call them influencers, because they affect the final views, not in terms of what they themselves believe, but who they choose to listen to determines to some extent who becomes a thought leader. And this has big effects on prices. So we see social network effects on prices. We see the potential of bubbles, excess volatility, price momentum, fundamental momentum, and reversal. And so these are all very typical things we see in stock markets, phenomena that have been puzzling to researchers, phenomena that have other explanations, but I'll argue that there are some distinguishing features of this framework that allow us to test potentially whether this is the true driver and versus other effects. And as a summary, I think this might be the true driver of momentum, who knows, but we need to test it more. I think the value effect and reversal could be part of it. It could be other explanation for that as well. In terms of portfolios, what I find here is that portfolios differ across investors. You know, we know that's true in the real world, but we know that in the many standard theories like the capital asset pricing model, people actually have the same portfolio. And here I also find that there can be bursts of high volume and high trading volume. So, you know, it has the potential to explain some of the typical things we see in markets, but again, it's just one small step in that direction. So I think it can help explain some of what we see in GameStop. And I think also it has many of the same characteristics that we see in all the historical bubbles known to man. And so those have been described very well by Kindleberger and Schleifer and others. So I'm going to try to end by making that relation. So in terms of the related literature, I don't have time to go through this in detail, but there is obviously a big literature on networks. There is a well-known paper by DiMasso, Mayanas, and Zwiebel, which is sort of what got me started thinking about the model I wrote down, which itself is inspired by a classic model by de Groot. And what is new in my model is that I introduce rational agents into this model, because in finance, I think we always want a role for the rational arbitrageurs. In these de Groot models, actually, typically, there is no rational agents because it potentially makes the model much more difficult to solve. I show actually in my version, having rational agents does not make it more difficult. I find a simple way to introduce rational agents. And I also have security markets, which is also not the case in the literature. There are, as I mentioned, other explanations for momentum and value based on behavioral finance and other effects. But what's new here is I have these network dynamics, which are not the driving force in the literature. David Hirschleifer, who also gave a talk yesterday, obviously had a presidential address where he talks about, you know, social effects. So my paper is sort of in the spirit of the agenda that he's putting forward. In terms of his model specifically, you know, my model is quite different because he doesn't model a network. He's focused on just sort of random meetings, but then he's looking at a social transmission bias, which is a different effect, an interesting effect also, but a separate effect. And then there's a big empirical literature, which in some sense is leading the theory in this area. There are some really interesting papers, for instance, looking at Facebook data by Teresa Kugler and Johannes Strobel at NYU and others, where they find actually very, very compelling evidence that there are these network effects. both in stock prices and house prices and so forth, in terms of people's expectations, in terms of how they trade, and in terms of how securities are valued. So,
question before
yes,
we move over, and actually somehow motivated by the fact that we just had David yesterday at this very conference. So when you think about what he put forward, the social transmission bias and the network effects that you mentioned. So could these two somehow coexist, or are they mutually exclusive / substitutory? If you have any perspective on that.
I think they could definitely coexist, and they can, make the market further from fully rational if they coexist. So I think they are complementary.
Thank you.
So, yeah, it's an interesting issue. And again, I think these are hopefully, testable things. So I don't have all the empirical tests yet, but I think these are things that can in fact be tested. And any other questions on the motivation? Otherwise, I will go into the model, and then I'll talk about the solution and the results. And then I'll talk about the connection to the GameStop example. So here's the model. There is one stock that trades in discrete time at time 0, 1, 2, 3, and so forth. There could be many stocks, actually. The model is to extend to that case, but let's just think of one stock. The stock has an exogenous supply S. S is the number of shares. And the stock makes an exogenous payoff, which is V plus U tau. And that payoff happens at time tau, which is itself random with a geometric distribution. So let me explain that in a simpler way. So the value has two parts, the fundamental value. U is a random walk, which is observable. And every period that there's a change in this value of the random walk can go up or down, and that change has a variance sigma u squared. And then V is an unobserved part we are trying to learn about. And at each time t, V is either revealed with probability pi, or it remains unknown with probability 1 minus pi. Okay, so let's think about the GameStop case. So suppose GameStop has all these retail stores. And the retail stores may sell more or less computer games in any time period, and sort of the value of those sales of computer games in the retail stores is sort of an observable thing, and we can think of that's this random walk U. It's it has some level, and it can go up and down, random walk like any typical security value. But then the thing about GameStop is some people say, well, maybe they can go online, maybe even though somebody else is selling computer games online now, maybe GameStop can also be part of this online computer sales. And some people say, no, well, it's too late. There's already somebody else who has sort of a lock-in on that area. And other people say, no, they can do it. And so this value V, we can think of this unknown value of GameStop going online. And people are trying to learn about it by talking to each other, talking to their friends. Can this really be done? And then at some time in the future, this time tau, what happens is that we figure out what is the value of GameStop. Could be GameStop goes bankrupt and we know it was 0. Could be GameStop is purchased by Steam or another online player in this market. And at that time, there's an exit at some value. Could be that people just figure out, okay, this is the value, the GameStop continues as a separate stock. And at that time, we know the value is V plus U. Okay, so that's the model of the security. And then we have N investors, and the game starts at time 0, where everybody gets a signal about this fundamental value V. So agent I at time 0, he has this signal VI. And if you knew all these signals, you would know this value V, because V is the weighted average of everybody's signals. So these kappas are known weights that sum up to 1. So the sum of kappa I VI is you can think of it as just an average of everybody's signals, but you only know one of them. And so you're trying to ask your friend, well, you know, what kind of V did you get, to try to figure out what is this value. And there are 4 ways of doing this and trading on this. Some investors are naive, or we can think of them as boundedly rational, or we can think of them as having what Demarzo et al. Called persuasion bias. Some are fanatic, some are rational short-term traders, and some are rational long-term traders. And I'll, on the next slides, explain exactly what I mean by these concepts. So let me first explain this naive guys. So the classic de Groot model works exactly like this. Let me focus on the numerical example. So suppose there are 5 people in the world. Of course, in the real world, there are millions of people, but let's just take the example of 5 people. So agent 1, he listens to all the other agents, or some subset. Actually, in the real world, you should think of the agent of listening to, let's say, 100 or 200 people out of millions. So in the real world, this weighting matrix, this matrix here is called the weight matrix W. You know, most of the elements of this weight matrix would be 0 because, you know, you only listen typically to some subset of all the people. But among those you listen to, you choose some weights. You don't pay equal attention to everybody, and so you choose some weights depending on who you want to listen to the most. And so in this numerical example, agent 1 puts 60% weight on his own previous opinion, so he doesn't completely abandon his own opinion every time period. And then he sort of updates that view based on what agents 2, 3, 4, and 5 say, and he puts 5% weight on agent 2, 5% on agent 3, 20% on agent 4, and 10% on agent 5. And you can see these numbers add up to 100%. Okay, so this is how, again, the de Groot model works. This is very typical. You have every agent has some weights of previous views. So they listen to other people's honest opinion about what they think the value is, and then they take an average where the weights add up to 100%. Now, what's special about a fanatic, and here I call agent 4 fanatic, XF stands for the fanatic view, is that the fanatic puts 100% weight on his own previous view. So he doesn't update at all. He just thinks, I think GameStop is worth 400, and I don't care what anybody else says, I'm going to stay at 400. Okay, so that's a fanatic view, that you put 100% weight on yourself and 0 on everybody else. Okay, and again, what's new in my model is I also allow rational agents. And so what is the rational thing to do here? Well, the rational thing to do in the first round is to listen to everybody, or collect all information there is out there. So while implicitly there's an assumption that if the naive agents have a lot of zeros here, maybe they don't have sort of information processing to listen to everybody. I assume that the rational agent are able to, they have, you know, computer system and so forth, so they can listen to all the relevant information. And then when they've listened to everybody, they weighted correctly by these coppers, and then they know the value. So at time 1, they update. So here agent 5 is rational, and suppose all signals are equally important, and he puts 20% weight on everybody. He doesn't put any extra weight on himself. He understands his signal is just one of many. He listens to everybody, and then he forms that rational expectation. But then interestingly, at time 2 and forward, he has already learned everything from everybody. And so at that point, he behaves as if he's stubborn. It's not really that he is stubborn, it's just that he has listened to everybody. He's figured out that GameStop, let's say, is worth $50 per share. And then if somebody keeps telling him, well, I really think it's 400, I really think it's 400, he doesn't keep moving in that direction. He just says, well, I heard you the first time, and that's part of my view, that I raised it from 20 to 50 partly because I heard you say that, but I'm not going to keep raising it. Now I'm just going to stay at that. So interestingly, the standard de Groot models typically do not have rational agents, and they do not have stubborn agents. But actually, what this shows is that having rational agents means that you naturally get stubborn agents, because after a while, once they've learned enough, You know, you can make the model more complicated, so it takes them a little while to learn the truth. But at some point, they're going to learn the truth, and then from then on, they're going to be stubborn. And then the second thing that I think turns out to be natural is to have other kinds of stubborn agents as well. And then the last piece of the model is thinking about how these agents are trading. So we have to figure out for every agent, what is the demand for shares. We have to make sure when we sum up those demands for shares, it equals the supply. And obviously the way we're going to clear the market is by set the price so that this becomes true. And I consider two types of traders. I assume that naive agents, fanatic agents, and some rational that I call long-term rational, they think about investing for the long term in the sense that they compare the current price with the value when the, you know, that is ultimately revealed. So remember that the value that you get at that revelation time was V plus U tau. Now, if you're a rational person, you know V after one time period, you figured out that your new updated view is the correct value. So you insert your correct value at that time. You say that the current value of the random walk is your best expectation of the future random walk. So the expected value of this, you see down here, is xi plus ut. And then you compare that to the price, that becomes your expected profit. And so this, your expected profit, is what you're trying to maximize, subject to a penalty for risk, for variance. And so that's the variance of that same thing. And the only little twist on that is when you compute the variance, it's over a random number of time periods. So from little t to this random time tau, and the expected value of this waiting time is 1 over pi. So if remember, pi was the probability of the value being revealed at any time. So if pi is low, we have to wait a lot, and then there will be a lot of risk. So the risk is sigma u squared over pi, and therefore the demand, when you differentiate this with respect to d and set the first order condition to 0, then you find a demand which is the risk aversion gamma multiplied by the risk, which again is sigma over pi, and then times that expected profit. So in other words, if the value in your view is higher than the price, you're going to go buy the stock, otherwise you might sell it. And this is a rational thing to do for the rational long-term investors, under the assumption, again, they realize that they know the true value, but also they are not trying to compute the short-term dynamics. They think all these network effects are complicated. They just think about that long-term value. For the naive and fanatic, this is not completely rational, because for them, their current value is not equal to V. It's their views are changing over time, but I'm assuming that they behave as if that what they now think is the value, they trade on as if that is in fact the true value. So that is part of their naivety. And then finally, you have a short-term investor who understands these network effects, who understands that people are talking to each other and that's going to affect the price. And for those investors, they have a demand which is also linear in the profit, but in this case, when they compute the profit, they compare the price today with the expected price next time period. And the expected price next time period consists of two components. I don't have a notation for the expected price next time period because I consider this PT is the price before revelation. So if, remember, 1 minus pi is the probability there is no revelation of the truth. And then this will be the expected price if we are still in this network effect. And then there's some probability that the value of GameStop will be revealed, in which case you get this fundamental value plus the random walk component. Okay. So that's the whole model. Yeah.
Right. Maybe that's a good time to bring in a couple of questions to the setup of the model.
Sure.
So the first couple of questions are think somewhat in the spirit of the beauty contest of that Keynes brought up, the thinking about financial markets, that maybe fundamental value is not what's of interest to investors, but rather the resale price. And so whether formulating beliefs in terms of price, if that would be something to explore in your setting.
Yes, I think that's certainly an interesting question. I think there is a lot of work in economics with asymmetric information and adverse selection, and people trying to learn from price, and people trying to think about what other people are thinking about. And I think this is interesting, but I think a large and to some extent overlooked part of economics is that people are just honestly talking to each other, trying to figure out the best course of action, and updating their beliefs over time as they learn more and more from their friends and others. And so I'm going to focus on this very basic phenomenon that just people talk and learn from each other, and actually assume that everybody is taking the price as given, everybody's communicating their view honestly, and still we get some interesting results out of that. But that's not to say that those other things in the literature are not relevant.
Okay, thank you, Lasse. The next question is a bit more specific to the news arrival here, because in the current setup, the news becomes stale after the second round. And could you allow for fresh news coming so that rational agents constantly learn, and that this variation would become relevant if the pool of all agents' news does not fully discover the truth right away, but more news will add more information?
Yes, I think that's a very interesting suggestion, and I think yes, that can be done. It's probably more realistic. If you want to think about the fact that there are obviously news coming out over time for any stock, you can think of my model as sort of just one simplified framework where we have almost what econometricians call the impulse response for one piece of news. So we have one piece of news, we see how that play out, abstracting from the new news, but in real life there would be new news. But for instance, in the case of GameStop, I don't think there has been much news actually over this whole period I'm looking at. So there was a new board member who came out in the end of 2020 and announced that they should try to focus on online sales, and presumably they're working on it, but I don't think there has been really important fundamental news over these several months.
Okay. And finally, there's a question if there would be ways of introducing a wealth effect, and then the issue of one type of investors becoming dominant in the market over time.
Yeah. So so that question I think has two parts. One is, could you have investors with different wealth? And that certainly you could. You could, for instance, have it. If you rather than just having absolute risk aversion, you get risk aversion and wealth, and then the results here. I'm assuming that people have the same wealth and risk aversion implicitly. But if you had them have different wealth or risk aversion, then the people who are more risk tolerant and wealthier would end up mattering more. That would be straightforward to do if you allow, or if you impose that those be constant over time. Now, if you assume that as people profit during the game, then they can then jack up their positions, I think certainly is a relevant consideration, but that would make the model more complicated.
All right, thank you very much. That's it for now in terms of questions.
Yeah, no, excellent question, thank you. So let me try to show how the model is solved. So let me start with the beliefs, so these X's, and let me sort of warm up with some special cases, then I'll go to my key case on the next slide. And let me actually warm up with this famous de Groot model. So in the de Groot model, that is the biggest focus in the literature, everybody is naive, and also everybody is connected. Connected means that not that I'm listening to everybody else, but that I'm listening to somebody who's listening to listen to somebody who listens to Michael, let's say. So for every other person, there is some path with which I can get influenced by their opinions. And what happens then is people start with these views x0, and then at time 1, they have a view which is this weighting matrix multiplied by the initial views. And so remember, the vector view x1 is a vector, and then we have this whole weighting matrix where every row adds up to 1, and then the view at time 0 is also a vector, so things add up correctly. And then at time 2, let me just delete this. At time 2, your view is given by the weighting matrix times the views at time 1, which then becomes a weighting matrix squared times the view at time 0. At time 3, it's w times x2, which is w cubed times x0. And at time t, it becomes w to the tth power times x0. And then when we want to think about how beliefs converge, it's all, the name of the game is how do matrices like w converge when we take them to a higher and higher power. And a famous result shows that this matrix actually converges to a matrix where every row is the same. And so another way to say that is that there is some consensus belief, let's say z prime x0, that everybody holds. Everybody holds that consensus belief. Okay. And the interesting thing is that the consensus belief z is not the same necessarily as kappa, which would be the rational thing. So the rational thing would be to weight all the signals by how precise they are. But what happens in this model is that signals are weighted by how much people listen to somebody, or how much social influence a person has, which might not be the same thing. And this z vector here, it turns out, is this left eigenvector of w, and that's exactly the way Google's PageRank works. So when Google's PageRank thinks about this, it looks at how many websites point to another website that's like listening to that website and so forth. Now, it's interesting to think about what if there's just one rational person here. So if there's one rational person, then what we see again is that the views are these powers of w times initial or time 1 view. So first at time 1, things are a little different. The rational updates in this particular way, but then the rational person effectively becomes stubborn. And so the rational person keeps repeating the same view. I think GameStop was 50, 50, 50, 50. Everybody else updates a little bit to what they hear, but since there's one person who doesn't update, in the long run, actually everybody's going to converge to the same thing. So everybody will agree with the rational person in the end. Now, this mechanism, there's a very beautiful result in the literature by Golub and Jackson, where they show that we get a rational convergence when the number of people actually go to infinity, if it's true that the influence of the most influential agent is very small. Now, in the real world, where Elon Musk has more than 100 million followers, where Kim Kardashian West has 200 million followers, saying that the most influential people are not influential is just not realistic. So, for the rationality to win out in the long run, it would have to be, I think, for my reason, which is that the truth is stubborn, that once you find the truth, you'll not be persuaded otherwise. But a strange thing happens is that it's actually not important that the person is stubborn about the truth per se. It's enough that one person is stubborn. So if there's one fanatic, and if other people, some people listen to the fanatic or listen to somebody who listens to the fanatic. So, if you completely have a crazy view and nobody listens to you, that would not matter. But if there's one person who keeps saying, my inauguration had the biggest audience ever, and people say, well, look at this photo and look at that photo, and clearly yours doesn't have the most. And if the person just keeps saying, no, actually it does have the most, that are the most people in my inauguration, if it keeps repeating that forever, then in the end, if people are listening, everybody will agree on this view. Okay, so my model says, wait a minute, in the real world, there are both rational people and fanatic people, and there can be many fanatic people with different views. What happens when we put all this stuff together? Okay, so the way that looks in my framework is, suppose again we have 5 people, and obviously in the real world there'll be many more, and there could be many fanatics, but let's just have 1 fanatic and 1 rational. Okay, and then this weighting matrix, it always looks like this, that the fanatic and rational, they're stubborn after one time period, so they listen to nobody else. So you have zeros here, and then you have the identity matrix here. And then you have the naive people, they listen maybe to everybody in some way, so you get a bunch of numbers up here. Then in the next time period, you get W squared. When you square this kind of matrix, you still get the zeros here, you still get the identity, and you get some other numbers here. Then we go to time 11. We still have the zeros, identity, some numbers. Then we go to time 101. Zeros, identity, and look at this. These numbers become themselves zeros. So now all this stuff is zeros. And this adds up to, every row still adds up to 1. So what's going on here is that now everybody's views, agent 1, 2, 3, 4, 5, they all only depend on the fanatic and rational views. So in the long run, the fanatic and rational opinions dominate the whole thing. And so this is the sense in which I model an echo chamber, that people are updating, but they don't take into account rational, the naive agents, that it's something the same information that circles back and hits them again and again. And there can be some people who listens mostly to the fanatic. Let's say here, X1 puts 65% weight on the fanatic, X2 puts 35% weight to the fanatic. X1 puts 65, 35. The reason he puts mostly to the fanatic is that initially he was putting 20%, 10. He was putting 2/3 on the fanatic. He ends up a little less than 2/3 because, remember, he's also listening here to agents 2 and 3, and those guys put 50-50 weight on the fanatic and the rational. The agents 2 and 3 in this example, they started putting 10-10s, or in other words, sort of 50-50 on the rational and fanatic. They actually end up close to 2/3, 1/3. Why? Because they listened a lot to agent 1, and agent 1 listens to the fanatic. So in some sense, agent 1 here is an influencer, because he has many people who listens to him or her, and since she has so many listeners who she listens to, in other words, the fanatic to a large extent becomes important. So the general result that I show is that this weighting matrix always has this form, that in my model, that there's upper left how the naive agents listen to one another, how the naive agents listen to the what I call the hard-headed investors. So hard-headed is another word for stubborn, which is sort of the rational, and the fanatics. Why did I not call it S for stubborn? Because S is supply, so I had to use something else. So H for hard-headed, and then the hard-headed, again, zeros and an identity matrix. And what I show is that naive opinions, they depend on each other through, and this is sort of the spillover matrix, and it also depends on the hard-headed with this kind of spillover matrix. But in the limit, as time converges to infinity, the naive agents only have views that depend on the hard-headed views. And this I call the echo matrix, that tells you how much they listen to the hard-headed investors. So let me show you a numerical example. For instance, suppose people initially thought GameStop was worth around 100 in this example, and then there are some fanatics who say, oh, it could be really worth 500 if we go online and make that a success. And then in this example, the rational people, they listen to the potential success for the 500. They listen to, well, maybe not. And then, this is certainly not realistic, I think, but let's suppose just you can think of it as another stock, that the rational thing, that the value is 300, and then the naive agent, they update more slowly, they listen to the various rational fanatics to one another, they start down here, and then they converge to all kinds of different views, but they are all somewhere in between the rational and fanatic. There's no consensus, but everybody listens to different degrees to the fanatic and rational. Yes, there's a question for Malcolm.
Yes, Albert, please.
Hi, Lasse. Great presentation thus far. One thing that keeps circling in my mind is, I think you've orthogonalized the value that people learn from the sort of dividends that come in between. So one thing, if I remember correctly, you had this GameStop example where you get information on sales through time, and then there's this potential that they might start an online version of GameStop, and that potential would be a big event. And I think that sounds, I understand that you do it, and it's helpful to get the channels clear. But the moment you allow those things to be correlated, things start to break down, if I get the intuition for your model correctly. Because if I learn from the dividends that it's more likely that they have the money to go big and start maybe an online presence, then I sort of learn, sitting in your community, that the fanatic guy, his views, the rational guy's views are more likely. I'm learning that he's closer to the truth than the other guy, because he's been claiming that's a high probability. The other guy must say it will never happen, or something like this. You see what I'm getting at? Is that the right intuition?
Yeah, I think that's the right intuition, although it corresponds to having many, breaking up the news revelation to having many little pieces. It would not change materially the model, but certainly in any numerical example, it would change it. But you would have a similar kind of effects, but they would be revealed in a more partial way. And I agree with you, that's more realistic in many cases.
No, but it's because now you have, if I understand correctly, that people will ultimately be somewhere on a weighted average between the fanatic and the rational guy. But if they learn that the rational guy's statements are more likely over time because they watch the signals coming in, then that weighting might actually start to shift, and maybe in the polar case all the way back to believing the rational guy completely. You see what I'm saying?
Yeah, they could learn everything over time. But again, I think in the medium run, that model would look very much like mine. And in the long run, we're all dead. So I do think, for all practical purposes, it would convey a similar intuition. Well, let me make sure I get through, and we can revisit this in the end.
Yeah, sure. Thanks.
One of the main results in this literature is that in the standard model, the group model, people reach a consensus. Now we see here that people do not reach a consensus in my model, and what's interesting then is, what can we say instead? In finance, what matters is actually not necessarily the consensus, but the average view. Because when people trade against each other, in the end, the average view, let's say, be somewhere in here. So then the question, what determines the average view? Well, the average view will depend on what the rational people think, what the fanatic thinks, but also the relative importance of those. And the relative importance of those, I call their thought leadership. So, for instance, in this example, it's true that the average view converges to 57% times the fanatic plus 43% times the rational. Okay, so I say that in this example, the fanatic has a 57% thought leadership and the rational has a 43% thought leadership. So what then determines the thought leadership? It turns out that, remember, we have this weighting matrix here, and in the weighting matrix, how much do people listen to the fanatic? This is how much people listen to the fanatic. He listens 100% to himself, The rational doesn't listen, but this is how the naive people listen. And it turns out that the way we compute the thought leadership 57% is to take the naive people, how much they listen, I put it here, and then multiply it by the influencer values of those naive people. So the first agent has a high influencer value because many people listen to him. So this is how many people listen to him. And the other two agents have lower influencer values. So we take influencer values times how much people listen, and then we have to add 1/5 because the fanatic, persuades himself, and that is 1/5 of the overall view. That will be a small effect if there are many agents. So this, in general, again, it's just 1/n, just because it's one agent. And so these influencer values, I'll tell you in a second how I get them, but what they mean is that if, for instance, agent 1 listens, instead of 20%, he listens 21% to the fanatic, then this number here will increase by 1.4% because his influencer value is 1.4. So the influencer value tells you how much can a naive agent move the average view by listening more or less to a fanatic. Okay. And so in general, as I said, thought leadership I define as when you look at the consensus, not the consensus, excuse me, the average view converges to a weighted average of these hard-headed views or everybody's views, and your weight in that final view is your thought leadership, and the influencer values are the column averages in what I call the echo matrix. And I don't think I have time to go through it now, but in the paper I show that that's a sum of my direct and indirect effects on everybody else. And what the result is then is that thought leadership is 0 for the naive people. For the hard-headed people, it depends on how much people listen to them and the influencer values of people who listen to them. And therefore, the change in thought leadership depends on people's influencer values when people listen to them more. In terms of prices, I want to get to the price before I run out of time. When we set supply equal demand, we see that the price depends on the average naive view, the average fanatic view, the rational view, the random walk, and a risk premium that depends on supply and risk aversion, and then the future price. And then we have this constant C, which depends on the parameters. We can then iterate this forward to infinity and solve for the price. And we can get, price patterns like this, where the price creates a bubble and then the bubble crash. But what we see in general is that the equilibrium price has a rational component and a network component. The rational part is the rational value XR, which is the same as V, plus this random walk U, minus a risk premium, again, that depends on the supply and the risk, and then a network part of the price, which depends on how different is the fanatic view from the rational view, how different are the naive views from the rational view, both now and in the future. And as over time, the network part of the price converges to this weighted average of the fanatic mispricings weighted by their thought leadership. Okay, so the implication is that the fanatics will move the price based on their valuation and their thought leadership. So in other words, if the fanatic increases their valuation xj by 1, they will move the price by their thought leadership theta j. And again, if you have all the data on the network, you can compute these thought leaderships. Second of all, if we think about a naive agent doesn't have thought leadership, but they have an influencer value. And what they can do is, suppose a naive agent follows a fanatic agent J by epsilon more at the expense of following a rational agent but less. In that case, the price will also increase by an amount, which is, what is the mispricing by that fanatic agent you're listening to, multiplied by the the influencer value of that naive agent. So in the example of GameStop, Elon Musk obviously is a thought leader in many things, but let's say in GameStop, he's more of a naive agent. He doesn't, go around studying GameStop per se. That's not his business. So in the case of GameStop, he's sort of an influencer. And then all of a sudden during the GameStop event, he started, tweeting about the people should look at Wall Street bets, which is sort of where the fanatics were. So this is an example where he's listening essentially now to the fanatic. And as a result, because Elon Musk has a big influencer value, and because these fanatics had a very high valuation, the stock price should go up in my model, and in fact, it did go up. If we look at the short-term investors in the model, their demand for stocks depends both on whether the expected network price is higher than the current price. So this is sort of a momentum effect, because the network component of the price is smooth, so they can sort of estimate this also by looking at past prices. And they also look at a valuation effect where they compare their current value, fundamental value, to the price. And the result is that they always trade on value or momentum or both. They never trade against both value and momentum. So in this example here, they have a long position initially because the stock is trending up and it's also cheap initially. Then the stock price gets overvalued, gets expensive, but they continue to have a long position because there is strong momentum and they're trading on momentum, but they're going against value. And then here, when it gets lower than zero, they're actually going against momentum, but trading a short position based on value. So this turns out to be a general effect that they trade on value and momentum. And it's also a general result that there will be spikes in volume and excess volatility. But let me not go into the detail. Let me instead spend the remaining few minutes just on the GameStop event. So, there are a lot of details about it that I gave a talk in Marcus Brunnermeyer's Academy that actually got me started on this research. And that talk, I believe, is still online, where I went into more of the details of what happened in January. But let me focus instead of what is the connection between the event and my model. So what we saw again is the price, I've been trading around 20, then it went up to 383, I think it was, in January. And at that time, Paul Krugman and others started tweeting that there was a connection to my old paper with Marcus Brunnermeyer on predatory trading, that there was a sense in which these retail investors were creating a short squeeze on the hedge funds who were short this stock in a form of predatory trading. Paul Krugman is normally sort of pro the little guy, but he was saying that in this case, it looks like the little guy is the predator. So obviously, Marcus and I were very happy that people were talking about our old predatory trading paper. So Marcus, he basically invited me to give a talk in his webinar to brag about our paper and say that our paper sort of explained this event. And of course, I couldn't say no. So I did that, but then I said to myself, well, it seems like it's not just a short squeeze. It seems like there's another thing here about, social dynamics, social network dynamics. And so I started working on this paper afterwards. Now, it seemed like at first that my old paper was the full story, because this is the short squeeze to a large extent. Then the short squeeze ended and the price collapsed again. So it seems like, okay, there was a short squeeze, the short squeeze ended, end of story. But then the stock price went up again and it has remained high, and now there's no short squeeze. So then, this could have been my old paper, but this has to be my new paper. In other words, no short squeeze, just crazy volatility we see here. This is 200% annualized, so enormous volatility. Turnover went above 200%, not annualized, daily turnover. So in other words, every share turned over twice every day for a few days. It's a completely insane turnover and very wild search activity, lots of discussions on social media. And we can see that those search discussions and social media effects, turnover, volatility, and price, they're all correlated in the time series. And as you know, correlation implies causality. So that, this must be all driven by social media discussions. So my paper must be correct. I'm joking, obviously. But what's the link to the model? The link to the model is that we have this investment idea that in case of GameStop, that they can make a ton of money going online that spreads via social networks, just as in Proposition 1. We have that fanatic ideas gain prominence over time, just like in Proposition 2. And in this case, fanatic, in my model, the idea of being stubborn is very important. And I think actually in the GameStop case, people understood that the stubbornness was important, because one of the memes that have played a big role in this event was diamond hands. So diamond hands is something that the people tweet like this, or put in Reddit like this, or you write it out. It basically means you must be stubborn. You must buy and never sell. You must buy and keep buying. So they understood that listening only to this group and being stubborn was important to sustain this value. We saw social networks affect the price, like in Proposition 3. And we saw that the fanatic view created a bubble, like in Proposition 4. But also, remember in Proposition 4, the more extreme is the fanatic valuation, the larger is the bubble. And I think there was also an appreciation of this phenomenon. People classified it as a YOLO trade, you only live once. And they used this rocket meme saying, the price gotta go to the moon, the price can be extremely high. And as I mentioned earlier, Elon Musk, he played the role of an influencer, making tweets, and that fits into the model as well. We saw sophisticated institutional investors trading on value and momentum, like in Proposition 6, and we saw very high volume and volatility. So in summary, I think social network effects are very interesting, and I think they could play a role in many things. When I look at the bubble anatomy that Kindleberger says characterizes every historical bubble, it starts with an initial displacement, just like in my model. It starts with people getting these initial signals that have some relevance. He says that then we get this speculation from the short-term traders, just like they do in my model. He says then there is a mania and emulation of investors. And in my model, the emulation basically happens every time we multiply by W, by W, by W. That's a way of modeling the emulation step by step. We get an authoritative blessing, just like the Elon Musk case with an influencer. Then finally, we get insiders who sell out, just like in my model. And we get a crash, which can be either from the revelation of the news, or revulsion as the fanatics or other people learn over time. So as Albert was saying earlier, we could have the news come out gradually, which can also happen in an inversion of this model, which would capture this revulsion, where the bubble doesn't crash. In this case, where there's revulsion, the bubble sort of peters out and then converges in that more slowly. I think, that also has implication for asset pricing in general, but let me leave a little time for questions.
Okay, yeah, thank you very much, Lasse, for this talk. Like I sort of expected, a lot of delicious little details from financial markets and how they actually operated through some crazy periods. So perhaps let's just give Lasse a virtual round of applause first for coming to the conference and sharing his insights with us.